Hey everyone, welcome back to Corporate Decoder, the place where we uncover the secrets hiding in plain sight in corporate filings. Today we're diving deep into a recent SEC filing that is packed with juicy financial details about John Hancock's funds. Get ready for a treat because we're going to decode some serious numbers and see what they really mean for investors. And remember, if you love getting these straight up insights from official documents, make sure you are subscribed and join our growing community on Discord, linked in the description below. This filing is from John Hancock Investment Trust and focuses on the performance of several of their funds up to the 31st October 2025. We're going to skim through the dense parts and zero in on what truly matters, focusing on the John Hancock Balanced Fund class for a good chunk of our analysis. It is like getting a backstage pass to the financial health of these funds. First, let's talk performance. The Balanced Fund class are reported a return of 17.17% for the year. That is a pretty solid number, and the report attributes it to strong US equity returns fueled by good corporate earnings, falling inflation, and excitement about artificial intelligence or AI. On the flip side, fixed income markets saw their ups and downs with falling treasury yields and Fed interest rate cuts helping to balance things out as the labor market showed signs of softening. The biggest boost to the fund's performance came from the information technology sector. A big thumbs up here for Broadcom, Incorporated, a semiconductor company doing great thanks to its leading position in AI chips. That is a real testament to how much AI is changing the game in tech investments. But it wasn't all smooth sailing. Apple Incorporated, a stock that many of us are familiar with, actually underperformed. The report explains this was due to slower revenue growth and not enough focus on AI. It is a stark reminder that even giants can face headwinds if they don't adapt. The fund even sold its position in Apple during the year. Now let's get to the numbers that really paint a picture. The fund's net assets stand at a massive $6.27 billion. That is a huge amount of money being managed. Think about that for a second, $6.27 billion. That is more than many countries' annual budgets. Of course, managing all that money comes with a price. Total advisory fees paid were over $32 million. That is a significant chunk, but it is important to remember this is paid out of those $6.27 billion. We need to see if the returns justify the costs. Looking at how the money is invested, we see that over half of the fund's assets, over 58%, are in common stocks. This tells us the fund is actively seeking growth and is not being overly conservative. Then we have corporate bonds making up about 15% of the portfolio. This is where the fund likely gets some of its income, and it suggests a balanced approach, not just going all in on stocks. The fund's portfolio composition shows a clear leaning towards stocks. Common stocks are the largest slice of the pie at 58.2%. After that, corporate bonds come in at 15.2%. US government agency holdings are also significant at 14.9% and US government holdings at 6.6%. The rest is spread across asset-backed securities, collateralized mortgage obligations, term loans, and short-term investments. Now let's break down where the money is invested by sector. Information technology makes up the biggest portion at 17.7%. This aligns with the strong performance contributors we discussed earlier. US government agency holdings follow at 14.9%, and then financials at 10.9%. Consumer discretionary is at 8.8%, and healthcare at 8.4%. Industrials come in at 7.0% and US government holdings at 6.6%. Communication services represent 6.3%, with energy at 5.6% and materials at 3.2%. The rest falls under other at 10.6%. When we look at the average annual total return for the Balanced Fund Class A excluding sales charges, it is 17.17% for 1 year, 9.93% for 5 years, and 9.04% for 10 years. Now let's compare this to the S&P 500 index. It did much better with 21.45% for 1 year, 17.64% for 5 years, and 14.64% for 10 years. So while the fund performed well, it did lag behind the S&P 500, the Bloomberg US Aggregate Bond Index, and the 40% Bloomberg US Aggregate Bond Index. 60% S&P 500 Index also provide context. The bond index showed a 6.16% return for 1 year, a negative 0.24% for 5 years, and 1.9% for 10 years. The blended index showed 15.29% for 1 year, 10.37% for 5 years, and 9.63% for 10 years. This comparison highlights that the balanced fund's performance, while decent, did not quite keep pace with the broader market indexes, indicating that picking individual stocks is a tough game. Diving into the statement of assets and liabilities as of the 31st of October 2025, we see total assets reaching over $6.32 billion. On the liability side, we have total liabilities at around $57.5 million. This leaves us with net assets of over $6.27 billion. The vast majority of the fund's assets are invested in securities, with common stocks being the largest portion. Now, for a really key number, net realized gain on unaffiliated investments and foreign currency transactions was a whopping $652 million. That is a huge win. Plus, there was a change in net unrealized appreciation of $177 million. This all adds up to a substantial increase in net assets from operations. And as with any financial report, we have the stamp of approval from PricewaterhouseCoopers LLP. They've audited these financials, and in their opinion, everything is presented fairly in all material respects. This is good news for anyone trusting their money with John Hancock. Now, for my take, the John Hancock Balanced Fund delivered solid returns, especially considering the market's ups and downs. The strength in information technology and a smart allocation towards higher yielding assets were clear positives. However, the underperformance compared to the S&P 500 is something investors should note. It really underscores the challenge of actively picking stocks versus simply tracking a broad market index. The fund's large net assets mean it has significant sway, but also a responsibility to manage those funds wisely. The fees are substantial at over $32 million, but they are a standard cost of doing business in professional money management, and the report suggests the board has scrutinized them and found them reasonable. Overall, the fund appears to be navigating the market effectively, although it has room to improve its relative performance against major indexes. The key takeaway is continued diligent management by the advisor and sub-advisor. Alright, that is our deep dive into this SEC filing. What is your take on these numbers and what they signal for John Hancock's funds? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more straight shooting corporate breakdowns. Don't forget to check out our Discord in the description if you want to keep the conversation going. Thanks for watching, see you next time.